A few moments ago, we looked at the rate table for employment taxes. Here is the income tax rate table for a single taxpayer. That's a filing status. We'll talk about that a little bit later, but not these chapters. In any event, you can see that the U.S. income tax rate structure is also progressive, going from 10% to a highest rate of 37%. And you can see the brackets, which is like 0 to almost 10,000, and then 10,000 to about 40,500, et cetera, et cetera, et cetera. And with each one, the tax goes up. And if you look, when you're calculating the tax, you basically take, well, you know what? Rather than do that, let's do an example. Okay. So SpongeBob has taxable ordinary income of $275,000 in 2021. How are we going to calculate SpongeBob's U.S. federal income tax? Why don't we go back and look at the chart? So SpongeBob's at 275, so that means he's going to be over 209,425, but not over 523,6. So we're going to take the 275 minus 209,425. That's the excess, and we're going to multiply that by 35%. And then we're going to add to that $47,843. So that $47,843, what that represents is the tax on every dollar up to $209,425. So that's the 10% through $99.50, another 12% from $99.50 to $45.25, another 22% from $45.25 to $86,375, et cetera, et cetera, et cetera. When you total all those up through $209,425, that's $47,843. So you add those two together, and that is SpongeBob's income tax. So Patrick provides the following information. So he's got wages of $60,000, interest income of $2,000, tax-exempt interest of $500. He's got an IRA contribution of $5,000, and I give you a hint because, I know you're not familiar with a lot of this information, or you may not be. This is a 4 AGI deduction. He's a single dad with 2 kids. The idea there is to try to hone in on his filing status, and he takes the standard deduction. So what we need to do is compute SpongeBob's AGI taxable income and pre-credit income tax liability. All right, we've popped over to Excel so that we can do some of these calculations. So let's start by calculating his AGI. So we know he's got $60,000 of wages. Let's label these. He's got some interest income of $2,000. The tax-exempt interest, that's actually not taxable, right? That's excluded, so we don't have to include it. We've got a 4 AGI deduction of $5,000, so an IRA contribution. And those can be limited, but in this case, it would not be. Well, let's shorten that a little bit. Gets a deduction for that. So that gets us to our AGI, right? We've got no other forms of income, and we've not got no other adjustments to income. So let's sum those up. We can put a little line underneath, make it feel fancy. There we go. All right. So now we got to consider his from AGI deductions. Well, he takes the standard deduction. So for that, we just need to know what is the standard deduction for head, for head of household, because he's a single dad with 2 kids, so he's head of household filing status. And if we go find the standard deduction amount for 2021, it's $18,800. So now we can get to his taxable income, the 57 minus the 18.8. So taxable income is 38.2. We've established that he's head of household, so we would need to pop over to the head of household rates. Here it is. So it looks like he's down here, right? So it's going to be 14.20 plus 12% over 14.2. So let's take the excess over 14.2, which is that, times 12%. And then add to that the 14.20. And there's the total tax. Let's call that income tax, just so we know. Okay. So let's walk through that calculation because I did it so fast just to make sure it's clear, right? Let's just quickly trip back over here, right? So we're in the head of household table. We're looking at about 30,000 of income. So we're in this bracket, 14.2 to not over 54.2. 1420 plus 12% of the excess over 14.2. That is precisely what we calculated here. Okay, let's hop back over to our slides. Okay, so the last part of chapter 1, or one of the last parts of chapter 1, talks pretty extensively about what it means to have good taxes. And the book I think is fine, right? It does a reasonable job. But if this is a topic that really does interest you, I've given you a quick reading list here, and these really are great sources for tax policy in the United States. It really goes even beyond income tax. They're just good about all taxes, and they're well researched and well written, and some are more Democratic focused, if you will. Some are more Republican focused. But I think when you read them all, they all speak pretty much to the truth. So if it's something that really interests you, I would encourage you to go, get one of these from the library and enjoy it. All right. Okay, so tax avoidance versus tax evasion. This is something that basically every tax course on the face of the earth in the U.S. is always going to teach you, which is tax avoidance versus tax evasion. So 1947 court case, Justice Learned Hand said over and over, again, courts have said that there is nothing sinister, and so arranging one's affairs is to keep taxes as low as possible. Everybody does so, rich or poor, and all do right, for nobody owes any public duty to pay more than the law demands. And this is the basic legal standard, right? You are allowed to try to minimize your taxes. That's called tax avoidance. So, for example, you pay for the parking for the CEO because you know that's treated as a non-taxable fringe benefit. So the business gets a deduction. The CEO doesn't have to pick that up as income. That's tax avoidance. Whereas if you pay the CEO in some form of unreported cash, well, that's tax evasion, right? The CEO is supposed to report that income regardless. So that's just evading the tax law. Okay, so a few administrative details to pick up on. Due dates are different for individuals, corporations, and pass-through entities. So as most people know, individuals file on the 15th day of the fourth month. Virtually every individual is a calendar year-end taxpayer. So that's April 15th. Corporations don't have to be calendar year ends. If they're a calendar year end, it's also April 15th. But if they were a November year end, it would be March. If they were an October year end, you'd back up 3 months. You see my point, right? So it's always going to be the 15th day of the fourth month for a corporation. Pass-throughs are almost all on calendar, but don't have to be. There are a few that might not be. They're the 15th day of the third month. So if it's a calendar year end, that's March 15th. And if the due date is on a weekend or a holiday, you move it. You get to move it forward, right? So you get a day or two. And there's an example from back in 18 where it actually got moved forward almost 3 days. So in any event, extensions are available for taxpayers. Individuals basically get an automatic 6-month extension. You're not even required to get it approved. You are supposed to file a form. You put the IRS on notice that you're extending, but they're automatically approved as long as you file it, and that's for 6 months. But be aware, an extension to file your return is not an extension to pay your taxes. All taxes are due by your filing deadline. Again, for individuals, that will be April 15th. The reality is they're not really due on April 15th. And when we get to estimated taxes, what you'll see is that you're actually required to pay them during the year. You can't wait until the filing deadline to pay all your taxes, or you're actually going to pay penalties and interest. So there's this idea, skipping around a little bit, there's this idea of a statute of limitations. This isn't just a tax concept. This is just a concept in the law. It prevents very old crimes from being tried in the courts. So for tax purposes, the law is 3 years. And it's 3 years from the later of the due date of the tax return or the date the return is actually filed. So if Yoda's 2021 year-end tax return is due April 15th, and he files on the exact due date, 4/15, then he would have 3 years, right? So let's say there's an error on the tax return. IRS has until April 15th of 2025, 3 years later, to assess Yoda. Once that's gone, except for some exceptions, the IRS cannot try to pursue against additional tax against Yoda beyond that point. If he files earlier than the due date, there's still no change. The statute runs 3 years from the original filing date. If, on the other hand, he files after the due date, let's say July 3rd, then the statute starts running from the actual filing date because that would be the later of the two dates. So, of course, like all general rules in tax, that has some exceptions. One is if there's a fairly large omission of gross income on that, the IRS wants to be able to try to pursue against that. So Congress has given them 6 years. A fraudulent filing means there is no statute of limitations if you commit fraud. So sometimes you'll see there's a number of court cases that work their way through the court systems as to whether or not the IRS can allege fraud against a taxpayer because that creates an infinite statute of limitations, which means they could go collect, really old tax assessments, assuming fraud is at play. And if you never file your return, then the statute never starts. Because remember, it's the later of the due date or the actual filing. And so if you've never actually filed, then that statute's never started. So a refund claim must be filed within 3 years of filing the tax return or within 2 years following the payment of that tax, if that's a later date, right? So that's a rule that basically captures if you waited a really long time to pay the tax, they're like, wait. If you didn't pay the tax on time, we're not going to give you that much longer, but we'll give you 2 years. So we'll talk about professional responsibilities in much greater detail in the next video, but I do want to point out that CPAs are subject to a number of regulations, either through their own associations, right, like the AICPA, or the state, or perhaps even the IRS. Now, and they're not all exactly the same, but they are pretty similar. So, of course, the AICPA has a code of professional conduct. So if you're a member of the AICPA, you're subject to those rules. And those extend, the code of professional conduct extends way beyond just tax services. It's a little bit of everything. The AICPA also has a statement of standards for tax services. And again, we're going to cover those in detail in Chapter 26. IRS Circular 230 is what covers practice before the IRS. So that's any tax advisor that is practicing before the IRS. And we'll talk about who those people are and what it means to practice. California has some statutes if you're a CPA. There's a business and professions code that applies to you. Those are the code sections. We're not going to go into those in detail. That's if you're a CPA. California also has tax preparer rules. We are one of the, I think, 2 or 3 states that actually regulates tax preparation. The vast majority of tax prep is not regulated. As the joke often goes, in order to cut hair, you have to have a license in virtually every state, but to file someone's taxes, you need no such license. Failure to comply can result in being admonished, right? So, finger wagging. You could be suspended by the state or by the AICPA, and you can even be barred from practice, right? They can be told I'm taking your license to practice, and you may no longer practice as a CPA, for example, in the state. You may no longer practice before the IRS, or you may no longer be a California tax preparer, depending on, which of the regulations you've run afoul of. Okay, that brings us to the end of Chapter 1. We'll go directly into Chapter 26 next. Thanks for watching.